Hello, everyone. My name is Armando Lanes. I'm one of the graduate financial literacy interns at the May Center. And today we're here to talk to you about personal finance, since this is the component of the Cisneros Financial Literacy Certificate. And before we actually go into the presentation, I'd like to ask you to complete the pre-test. You can do this by either scanning the QR code or typing the small URL that we have here. Pause the video and complete the test. And once you do that, go on to the next slide. As I mentioned, this is the financial literacy component, setting yourself up for success. And the agenda consists of four main aspects. One, budgeting strategies. Two, debt management and resources. Three, key financial calculations. Four, finance and leadership. And we'll actually start with budgeting, looking at the basic components. So one, we'll have goals. Two, we'll list our expenses. And three, how do we stick to it? And in order to actually cover all those overarching themes, we have a list that actually breaks it down a little bit more in order to understand our values and make sure that we go through all the steps that are necessary in order to successfully create a budget. The first part of that is, what are your values? So in this case, let's say that you value growth. This can take shape in many different forms, but for this example, we chose to have a person that values growth in the form of traveling. However, you might find yourself making a lot of expenditures in areas that you know don't particularly align with your values and that you know perhaps don't even align with your goals that you have set for yourself. And sometimes we can even feel it ourselves after a purchase where we get that remorse and say, well, perhaps I shouldn't have made that purchase. I probably should give this back or return it. So this is actually very important because in order to create a budget that is personalized and that you will stick to, we have to find out what are your values. And this is the activity that we've attached to this presentation, understanding our values. So if you've had the printed version, please go ahead and pull it out, have it next to you, as we'll actually work through it as we have each section. And if you have the format that's on your computer, you can minimize the screen and work through it just as well. The first part of the activity, just go ahead and take a couple of minutes to understand what are your personal core values. Here you'll see a list that has a lot of different values. It's actually cut because the list that you'll probably have in front of you is far larger. It does include the complete list. So take a couple of minutes and try to find 2 or 3 values that you see yourself gravitating towards whenever you make purchases, or even that if you want to build a budget, what are some of the 3 values that you want your budget to embody? So take a couple of minutes to do that. You can pause the video here so you can actually do that and then move on to the next aspect. Once we have our personal core values, for me, my top 3 values are going to be family, fun, and purpose. And that's the way that I really like to spend my money. I consistently, if I look back 30 days back, and even further, I can see that a lot of the purchases really do revolve around these sort of themes. And so that's how I came up with my 3 top values. The next aspect is listing some of the purchases that you made this month. So look back at the previous 30 days, and you don't have to list the whole 10 that the list in front of you asked for, but at least 5 that you can see yourself, some of the purchases that you made in the past couple of days. For me, it's been going out to dinner, buying some shoes, 3, buying a suit, a laptop, and a computer monitor. Again, you can pause the video at this time in order to list some of the purchases that you made in the past couple of days. Once you have that list, you can move to the next section. Here's really where we put these first 2 sections together because we want to find out if our purchases that we made in the past couple of days actually do align with our values. So for this one, ask yourself, for example, part of the exercise is asking yourself which of the purchases that you made did you feel good or bad about? And going back to what I mentioned before, what are some of the purchases that you knew really aligned with your values, and which ones did you know right away? Perhaps I shouldn't have made that purchase. It was probably an impulse buy. So ask yourself that question. And then which purchases align with your values? So first ask yourself this question so you kind of get an idea of what you're going to have as an answer for each item on the list. And then we'll actually type out or write out which of the purchases align with our values. So for the number one purchase that I have here is going out to dinner. Now this actually does align with my value of fun and family because I did do I did go out to dinner all these times with my family, and it was fun, definitely. However, I did list here that I did do it 3 times in a row. So 3 nights in a row, I went out with my family and I had fun and I had dinner. But here I even noted it doesn't align with my values because, well, I could reduce this. I want to keep having these purchases, but perhaps making it a little bit less would be the best option for me. Number two, sneaker shoes. So this one doesn't align. It would probably align with fun. However, I know that after I made the purchase of these shoes, I knew right away that I wasn't happy with it. I probably did it just because I thought it was a great deal, but I'm really not going to use the shoes. As a matter of fact, I really haven't used them since I bought them. So again, you can see that this ideally for me would have probably been within that category of fun, but it turned out that it really wasn't a good purchase for me. Next, you see the suit and laptop. Yes, both of these purchases would align with purpose. And one of the key things that I design or that I define that purpose as is bettering myself and making sure that I continue to have professional development. So both of these were aspects that in one way or another, I believe that I felt good about the purchase and I know that they align with that value. The last part is the computer monitor. And this one, I don't think it aligns. And it was mainly because when I went to buy the laptop, I got offered a computer monitor as an addition if I spend so much money more. And I knew right away again that this really wasn't going to align with the values that I had set up for myself. So the main purpose of this activity really is to bring to the fore what are some of your values and seeing if the purchases that you're making are always aligning with your values. If they're not, well, now we know what are some of the changes that we can make. And even we can go back here and say, perhaps we need to revise this list. Once you're done, keep that page next to you or keep that window open because we'll actually use it as a part of our goal setting strategy. So now that we have the map for our budget and we've understood our values, what values can we use to set our goals? In this strategy, we'll use the SMART goals. And here, if you don't know or you haven't used the SMART goals strategy, it basically means that your goals are being specific, measurable, attainable, relevant, and time-based. And the reason for this is that we want to ensure that once we set ourselves a goal, we're going to achieve it and we have it set up in the format that is going to make it simple and straightforward for us to measure our progress. A great example of goals that are not generally SMART goals are New Year's resolution. These tend to be very vague and very large in scope and don't ultimately set us up for success. As a matter of fact, you can see how people tend to scrap them a couple of days, even a couple of weeks later after they set them because they don't go through the process of setting them up as a SMART goal. And that's what we're going to focus on this part. So for this example, in order to show you how to set up a SMART goal, we'll look at saving the $50 per month. So the S is specific. We made sure to make this goal as specific as possible. So in this case, we have $50 every month that we want to save. For you, it could be perhaps that you want to have maybe $50 in your account left over at the end of every month, or perhaps you want to save a bigger amount that we have set up here. This is just, again, an example. So we made it sure that it was as specific as possible. Make sure that when you're trying to do your goal, narrow it down as much as possible, because once it's specific, it really gives you an idea what is it that you're going to drive towards. Next, we'll look at measurable. How do we get to $50? So in this case, let's say that there's 31 days in a month. That $50 divided by 31 will give us 161. Ideally, you probably don't want to have all those pennies lying around, so maybe you want to round it up to say 175 a day that you want to save. But the importance of this measurable step is that it gives us a yardstick. I now know that every single day I have to have saved $1.61 in, be it my piggy bank or the jar where I'm saving my money up in, to know that I'm making progress towards my goal. So this gives us a yardstick, or the units by which we measure our goal. Next, attainable. How much have we saved in the past? If we had trouble saving smaller amounts, say 20, 30, or $40, then this might not be attainable. And make sure you really put your goal through a really strict filter, just to make sure that you're setting yourself up for success, because this step is crucial to determining whether you might have to recalibrate later on. Next, relevant. And this is where the values part comes into play. Think about your values. What are you saving for? Again, if you set yourself the goal of saving $50, well, what value are you aligning it to? Is it with fun because you're saving $50 because you want to have money left over to go out with your friends? Does it have to do perhaps with frugality because you want to have some money left over and start saving? What are some of the reasons why you're saving? And if you notice that perhaps you didn't set up your goal in accordance to your values, go back to the first step, just to make sure that you're setting it up so that you're going to stick through your goal when it gets hard, and you are actually going to achieve it. The last part is time-based, and this is extremely important because we want to measure our goal. Generally monthly, that's a good point to start up in, but just have a start and an end date. Why is start date? Well, it lets us know when is it that we're actually going to start, of course, but it lets us see our progress. So let's say that you started 10 days ago. From those 10 days, how much progress have you made towards your goal? And then if we have the end date, it's really, really important because it doesn't make our goal seem endless. So that's extremely important to keep in mind whenever we're setting up a SMART goal. Okay, perfect. So now we have our goals set in mind, by which in which this case we use the SMART goal strategy. Next, we'll look at fixed and variable expenses. So listing our expenses, there are really two categories. And for example, we'll look at some of them here. We'll have food, shopping, perhaps some more shopping, going to the grocery store, and again, shopping, but it might be something like sneakers that you go buy. So the two categories that I was talking about are fixed and variable expenses. And the difference here is key, because variables expenses generally tend to be things that we don't see recurring in our budget every single month. Think about sporting events, vacations, or even going to concerts. For me, at least, none of these things are generally recurring in my budget. But let's say that you're a sports fan and you actually like to go out to sporting events. That's something that you particularly value. Well, perhaps that's not in the variable column, but that's in a fixed column. And perhaps you're a person that likes to make travel something that they value. Again, this probably wouldn't be in the variable expenses, but it might be in the fixed. So it does depend. These are just some general categories that for most of us, we generally don't recur to every single month. And for the fixed expenses, you'll see a common theme. These are things that we have to make expenditures for either on a weekly basis or a monthly basis. So think about groceries, getting gas, and again, food, whether it be fast food or just going out to eat with your family. These are things that you generally see consistently popping up in your bank statements. So in order to clear it up a little bit, we're only going to focus on the fixed expenses. Why? Well, generally when we look at variable expenses, since they don't pop up that often, they might make it a little bit harder to budget. So we'll only focus on the things that we consistently see in our statements every month. So for the fixed expenses, again, this is just an example of a list that somebody might have as their expenses, but it can just as easily change. So for me, I see fixed expenses in regards to groceries, gas, utilities, car payment slash insurance, fast food, shopping, transportation, travel, gaming. And you can see, for example, if somebody spends money on makeup and clothes and other categories as well. So these are fixed expenses since they consistently pop up for somebody. Now, in order to narrow it down and get to the real core of what we need to save for every single month, we'll look at what is called our obligations. So out of these things, what are absolutely must for you? These are the things that you cannot live without. Well, in general, we could think of groceries, gas, utilities, car payment or insurance. Well, we really can't as easily get rid of those. And maybe fast food, perhaps, if you have it as something that is an absolute need, if you don't get to cook a lot at home, right? This is something that you absolutely need to have every single month budgeted for, then include it. But for me, we'll actually look at our obligations. So like I mentioned, utilities, gas, car payments, groceries, and insurance. And you can see the examples of them here. These are things that I absolutely have to take care of every month. I really can't skip on them because they're my needs. So how does this help me in creating a budget? It provides me my number. In this case, it's $750. And now I have at least a starting amount. So you see from that big list of expenses that we originally had, now we've been able to distill it to the very basic at the very least, I have to make sure that my budget covers my basic needs, which in this case is my number, 750. Okay, we have our number. Now that you've taken care of your basic expenses, what are some of the things that you could live without? And in this case, here's what needs versus wants really comes into the conversation. Again, it's not to say that you have to cut everything, but again, we bring in our values and what are some of the things that you might have seen in that big list that we had before our number that you say, well, that really doesn't fit into what my values are, and maybe there's some cuts that I could make here. So in order to eliminate unnecessary spending, here are different strategies that we can employ. Number one, understanding our core values. Again, these are extremely important because they're our guiding light. They let us know which are some of the expenses that even though we have a hard time getting rid of them, we know ourselves that they're not going to get us to our goals. And then we have eliminating multiple payments in, for example, credit cards and consolidating debt. These two are very similar. And again, this is trying to simplify our personal financial lives because if you have several payments that you have to make in different aspects or for different, let's say, credit cards, you're making it a lot more difficult on yourself. Again, this is just an example. It could be eliminating multiple bills or consolidating your bills so that you only have to pay one bill at one time and that takes care of your utilities, your gas, or that you have an auto payment system set up. That's just an idea that we want to have as part of eliminating unnecessary expenses. The next part, paying with cash. Why do you think it's important to pay with cash? Well, for one, when you reach in your wallet and there's no more, that's it, right? You're out. There's literally nowhere else to go. Just as well, you see it coming out every single time that you make a purchase. So you actually start taking count of how much money is leaving your money and how much money is leaving your wallet. So it's important to have that as a strategy that you can turn to in order to perhaps eliminate some unnecessary spending in your life. And again, recurring expenses. Think towards, let's say you have 3 different streaming services that you absolutely pay for, and you say to yourself, I perhaps don't need to have all these 3. I could eliminate one without making any radical changes or impacting myself in any negative way. Well, that might be a way to get started with eliminating those recurring expenses. So we've completed all these different aspects and we've set ourselves up so that we can actually create a budget and that will allow us to have our values in mind and that will have us set up for success. And that's a recap that we have here. So we've created a budget with our values in mind. How do we set up our achievable goals so that we can use the progress to get to our budget and actually make sure that we achieve those goals that we've set up? And last, how do we eliminate some unnecessary spending? Now we'll actually turn to debt management and resources. And this section is a little bit shorter than the last one, but it is extremely important because we'll talk about federal student loans. Now, some of the characteristics of federal student loans is that they have generally more repayment options. They tend to have fixed rates. They can be subsidized. There are options where you would have options to have subsidized loans, and they generally, again, have lower rates than the commercial loans. So in the table, as you can see here, there's 4 different categories that we'll talk about. For direct subsidized loans, you are generally not charged interest while you are in school. That's where the subsidized part comes in. However, you want to remember that there are borrowing limits. You can get to a limit where you can no longer borrow more subsidized loans. Next, we have direct unsubsidized loans. And as you might have guessed it, yes, there are also more borrowing limits, but in this case, the interest do accrue while you are in school. So you see that there's a big difference between these 2 categories. Next, for direct plus loans, these are for parents generally trying to be co-signers and getting loans to help students pay for school and graduate students, and they may be used to cover the total cost of attendance. The last category isn't really a category per se, but it is a different way of looking at loans. So for example, if you have consolidated several student loans, you may allow yourself to get forgiveness. And I really want to emphasize the may part here because it does vary, but that is definitely an option. If you do choose to consolidate, you can look at how there might be benefits in that. However, I do want to really emphasize that it may. It's not every single time. And just as we've covered some loan, these bigger loans that have to do with students, there are also different loans that we might not think of them as such, but that have a really big impact in our bottom line. And think about the thing that you have in your pocket to make calls and to text your friends. Well, if you think about it, you also have cell phones, right? And that's actually one of the areas that we'll cover in the next slide. I'm actually getting a little bit ahead of myself here. But before we actually jump into that, I have the student loan repayment options. So generally these have to do with students that have federal debt, where you work in public service programs that allow you to have your loans forgiven. One of the key things about these, generally the characteristics have you holding a qualifying job for 10 years and making payments to open yourself up for eligibility. And there are different federal employee programs that allow you to repay your options and have either early loan forgiveness or where your employer will repay your loans for you. In that case, because you're part of that federal employee program. And here's the other aspect that we were touching upon a little bit ago, the other loans, right? So how did you get your phone? As you can see here, 35% of us really didn't purchase our phones outright, but we actually financed them. 22% of folks actually had it where they didn't finance it, but they actually purchased this outright. And you can see that there's other categories here as well. And the point of this slide is just to show that every single time that you have something that is a recurring expense, it can take a lot out of the bottom line. So things as small as phones that we generally don't think of as loans per se, if you did get it financed, you're not only paying off for the phone, but you're also paying off the interest on that phone. And that, again, is a recurring expense that you need to budget for because it will have a long-term impact on your bottom line. Okay, and like I mentioned, this was a little bit of a shorter section. So we looked at the characteristics of student debt, some of the debt management strategies, and how small bits and pieces of debt do add up. And now we'll shift gears to look at something that probably should look very familiar to you because it's the numbers in finance section. And these numbers are actually all part of the pre-test that you took beforehand. So we'll talk about inflation, savings, taxes, investments, and credit. And we'll actually look at all these different problems and work through them together. So for the first one, we have inflation. Inflation is generally taken to be the increase in prices for goods and services from one year to another. We also have savings. So how do interests have an impact on your savings? Taxes, of course, those are important because how are taxes taken out of your account and how do they change what you get in gross pay and what you actually get in take home pay? Next, we have investments. We look at the different asset classes. And last, we look at some of the credit characteristics. So to start with inflation, imagine that the interest rate on your savings account is 2% a year and inflation is 3% a year. After 1 year, would the money in the account buy more than it does today? Exactly the same or less than today? So think about it before you actually answer it. Do you think it would buy more, less, or about the same? And so in order to set this problem up, let's say we have $100 that we start out with. So first, what we want to do is calculate the interest. So we have the initial amount of $100. You take it to the bank and the bank teller tells you you'll have it here and you'll actually accumulate 2% interest. So at the end of that 1 year, you'll be able to get $2 on those $100, right? So if we were to calculate the interest, you would just take the initial amount, which is 100 times 0.02, again, the 2%, and we would get the $2, and we would add those two together. So we have 102 at the end of 1 year when we leave our money in that bank account. Now, we also need to calculate the inflation, and we'll do it in a very similar way. So we have $100 plus the interest. In this case, it's not the interest rate, but it's the inflation rate. So it's the 100 times 0.03, which is $3, and it's a total of $103. So how do we bring these two numbers together? Well, let's say that the year is 2019. At the very beginning of 2019, you go to the supermarket and you can buy everything you need for $100. Now, in that time, you went and left that money in the account for you to get those interests. So a year's passed. It's now, let's say 2020, for example. It can be any year, but let's say it's 2020. And in 2020 now, you go to the supermarket and you think to yourself, well, I've got $2 more, so I'll probably be able to buy everything I need and then some, right? Well, in this case, you probably would be wrong. The reason being that once you go and actually check everything out, everything that you used to buy for $100 a year ago now went up in price by 3%. That means that you would have to pay a total of $103 at the checkout stand, whereas you only saved 102 from that year ago. So in this case, you would actually be able to buy less than a year ago. Next, suppose you have $100 in savings and the account is earning 5% interest a year. After 5 years, how much would you have? And before we actually go through the problem together, how much do you think it would have? Just have a mental guess in mind. Do you think it would be like 110, 115, 120, 125, 135 maybe? What do you think would be how much you would have at the end of that time period? So in order to actually begin to set up this problem, let's set up a timeline. So we have today, year 1, year 2, year 3, year 4, year 5, and we'll use the mechanics that we actually used in the previous slide. So today we have that $100 and we want to calculate the interest as the year goes by. So we start with the $100 plus the interest. In this case, it would be 100 times 0.05, which would give us $5. Add that up and we'll have 105 at the end of year one. Now, the key lesson to take away from this is that that year passed by and your money worked for you. You got that 5% interest, and without really doing anything else other than keeping it in the bank, you were able to have those interests. For year two, we would do the similar computation. So we'd start with 105 at the start of the year plus 105 times 0.05 again, and we would end up with 110.25. Again, you can see here's the power of compound interest. If you leave your money to make interest for you, the interest start working as they continue to accumulate, so you get more and more money. So you get, at the end of year five, $127.62. So if your guess was around that ballpark, you were correct. Now, the next problem, we won't have any mathematics or any sort of computation with it, but we do want to emphasize one good rule of thumb. So let's say that I lent you $10,000 at 3% interest to help you cover college expenses for the coming year. You can choose to repay this loan over 10, 20, or 30 years. Which of these repayment options will cost you the least amount of money over the length of the repayment period? Now, before we actually go forward, what do you think would be the best option? 10, 20, or 30 years? And why? In this case, as you can see, there are two graphics here, right? And so whenever you have to repay a loan, you have to repay the principal, which is the 10,000, and the interest. So the rule of thumb to keep in mind here is that whenever you keep a loan for longer amounts of time, you'll have to pay back the loan itself, yes, the principal, but you'll also have to pay the interest for a longer period of time. So if you have a loan, in this case, let's compare 4 years, right? You'll have to pay the 4 years of principal plus interest, whereas in this case, you would have to pay only 3 years of interest and principal. So in this case, the correct answer would be the 10-year loan, because if at all possible, you want to make sure that you repay the loan in the least amount of time. Next, we can look at average take-home pay after deductions. And we actually have the answer here. On average, from what you actually get paid, you'll only get to take home 70 to 79%. That's on average again. So in this example, for this person, we have them getting $4,125. Now, they don't get a check for that, right? Because we have to make some deductions. In this case, we have the medical insurance deduction, retirement deduction, and then also some taxes. So federal income tax, Social Security tax, and Medicare tax. So from those $4,000 and $4,125, after the deduction, this person is actually going to get a check for $2,873.07. Next, we'll look and ask this question. Over a long period of time, which of the following types of investments will give you the highest rate of return on average? And we have 3 different asset classes. One, we have the S&P 500, and this asset class is just meant to give us an example of what stocks in the stock market would look like. Then we also have bonds. In this case, we use a 10-year government treasury bond, and then we have online savings account. And so, as you can see, we have average returns ranging from 10% to 1.5% to 2.2%. The asset class that provides the highest average annual return in this case is our stocks. So a value of $100 invested for 10 years would yield $271. A value of $100 invested for 10 years equals $117. And again, the same equation for online savings account would yield $125. Now, this is by no means in any way investing advice, but it allows us to see how the different asset classes perform. Next, we'll look at credit cards and the advantages that they bring us as well as the disadvantages. But before we actually go into the tables that we have here, I do want to mention that one key thing about making minimum payments. And that is that over the long run, if we make only minimum payments on our credit card balances, it may have a negative impact on our credit. So that is something to always keep in mind whenever we're looking at making credit card payments. And so here we again have the different types of credit cards. First, we have rewards cards, and you can see these are cashback cards, stores where you would get the retail cards, or even airline points cards. And the big detail about these types of cards is that you want to make sure that you pay them in full. Otherwise, there really isn't any point in getting them. Why? Well, think about, for example, cashback cards. If you let's say that you get $70 in cash back, right? But you have to make $80 $80 payments in interest, well, you're still losing out $10. So doesn't really make sense to get them. Next, we have low interest cards. Here the trade-off is that you don't get any rewards, but you may receive a lower rate than that of a rewards card. Next, balance transfer cards. Here you can take advantage of very low rates, and it's for folks generally that have really good credit. And the way that balance transfer cards generally work is that if you have a balance that is going to be due in a couple of months or in a certain time period that's approaching quickly, you can take the loan, let's say, or that amount in that card, let's say it's $100, transfer it to another card that has a lesser interest rate, and pay off your old loan with that old card. This allows you to essentially refinance that amount that you owed and take advantage of a lower rate. The last category is secured debit. These cards are generally for account holders that have no credit and are trying to build it, or that have a bad credit and similarly are trying to rebuild it. And now that we've covered those types of credit cards, what are some of the advantages? Like we mentioned, you can build credit, and establishing a credit history is important because if you want to borrow at lower rates, one of the key factors that lenders will look at is your credit history. So if you're able to establish a credit history, it will be beneficial to show lenders that you do pay your loans off and that the time that you've spent paying off those loans has actually made sense for people to lend you money. Next, we have rewards. Again, they vary. Here we have cashback, stores, and airlines. Those are the big categories, but again, it can vary from retailer to retailer. And last, they offer flexibility. So if you need to make a payment and it's an absolute emergency that you have to take care of right now, then having a credit card can offer you the flexibility of making that payment. As there are advantages, there are also disadvantages with credit cards. So here we have interest payments. These generally can be fairly high. Whenever you don't pay off the bill in full, you generally get a really high interest rate where you need to make those payments. You also have annual fees. You have late payment fees, balance transfer fees, and foreign transaction fees. One of the key things about credit cards is that you just want to be familiar with the different types of fees that are associated with your account so that you don't get a surprise. And here we're trying to really drive home the impact of interest. So let's say that you went to the bank and you borrowed $100,000. Well, in the next 12 months, the payments that you have been making, which have been pretty much the same overall, $599.55, of those payments, you will have paid a total interest of almost $6,000. So as you can see, securing a low interest rate is extremely important in order to be able to actually get better terms that allow you to pay less amount of in interest. Now we'll actually start shifting to the aspects of leadership. Since this is the leadership certificate, we do want to talk about some of the different skills that you can continue to develop in order to be competitive in the labor field. So what are some of the hard skills that you think that employers look for when they're trying to hire someone? Well, this is not an all-encompassing list, but if we were to look at the field of business, there are, for example, things like accounting, understanding of the rules, the financial statements, understanding what each statement functions, and how each of those statements serve a particular function, preparing a budget, analyzing variance, and ratio analysis. And as you can see, with hard skills, they're generally particularly geared to completing a certain task, right? They're not particularly involving people, but rather the task itself. And that leads us actually to soft skills. What do you think are some of the key soft skills that managers and employers want to see in candidates? Well, again, communication, teamwork, adaptability, and conflict resolution are among some of them that people are looking for when they hire individuals and bring them onto an organization. So, again, you can see the big difference is that with soft skills, we're generally looking at how is it that a person interacts with the team and how is it that they interact with people in the organization in general. Now, this is important because when we are talking about statistics and leadership, you can see that in the United States, there are a lot of different jobs that now can be performed through a robot, an actual machine, or through generally software. And so, as you can see, generally, when we have the job outlook, it is those jobs that are very repeatable that can be outsourced or that are simply being taken over by specialized software that has already acquired all those skills. Whereas the jobs that are generally growing in popularity are the ones that have these two key factors, which are the hard skills, or generally here we have a graph that says math skills. I would just say that that's generally hard skills. And also the social skills, the soft skills that we talked about. And why is that important? Because the combination of understanding what is it that you are able to do specialized or the skills that you're doing in the job are important, but just as well social skills, because that combination is very hard to automate and very hard to replace by a machine because it generally takes into consideration that you're building a relationship with another human being. So as you can see, these jobs that are in green are the ones that are growing because they generally have to do with talking to people and actually building that relationship from scratch. And here's a recap really quickly. So we talked about the steps to creating a budget, simplified some of the daily operations we have with numbers in finance. We talked about some of the key leadership attributes needed as you go into the professional world. And next, we'll talk about some of the additional resources and finish with a post-test. So as I mentioned, at the May Center, there are different services that you can take advantage of. For example, in career services, if you want somebody to take a look at your resume and give you some tips or pointers in order to make it a little bit better, you can set up an appointment for that. Or if you need a tire to attend an interview, you can attend the Career Clothes Closet, which again is at the May Center, and you can get a complete suit or any attire that you need in order to attend that interview, and that's yours to keep for the life that you're here at Texas A&M San Antonio. And like I mentioned, there's a lot of different resources that are available for you to take advantage at the May Center. For example, if you also have any questions that popped up throughout the duration of this presentation, we have money coaching sessions where you would be able to sit with one of the financial literacy fellows and ask them any questions that you have regarding personal finance, and we would be happy to help you in order to set up an action plan to tackle those financial goals. Now, this is the last part. So if you could please once more either type the tiny URL or the QR code in order to take the post test. And just as well, you can pause that and go through the different questions. I would also like to thank you for your time in attending this presentation.